This is such a specific topic, valuing a business, and there are 4 different methods. If you read the title, this is course 4 and this will be on the exams. Almost all of the Humber exam reports I see, there's one consistent area students seem to struggle with over and over again. Valuing a business keeps showing up. C4 and even into simulation session 2 can be a bit of a grind for students, of course, because most won't be getting into commercial. If you plan on getting into commercial, that's amazing. However, most won't. Either way, we have to learn it to pass the exams. 4 methods for valuing a business are direct capitalization, gross profit multiplier, adjusted book value and asset valuation, and discount cash flow. As usual, if you are looking for additional support to pass these exams, look for my Exam Master mini courses in the description below. More on that later in the video, but let's just dive right into it. Okay, so business valuations usually focus on gross income. However, there are more refined methods depending on business type and size. First, direct capitalization. This involves estimating the property's value based on the income it generates using a capitalization rate or cap rate. Cap rate is a very small math formula that is used to estimate the investor's potential annual return on the investment relative to the property's current market value. Annual income generated by a property, just think an investment property and think rent from tenants. And current market value, just think that you are comparing local properties that are similar to your property and finding out a good price that could sell in the market you're in. For example, 25,000 of NOI divided by a property that's valued at 500,000 gives us our cap rate of 0.05 or 5%. Again, direct capitalization method, just think cap rate and think small business. 3 quick things to consider when you are using the direct capitalization method. 1, the property is an income producing asset like an investment property as mentioned, or even an apartment complex. 2, the property's income is relatively stable and predictable. And 3, there are comparable properties in the market to derive an appropriate cap rate from. This method would not be appropriate for properties with high variable income rates, not predictable, or future development stuff years into the future, or even if it was very hard to find comparable properties. That's something that may appear on the exams. Direct capitalization reflects a 1-year term. Shorter term, not long term. Keep that in mind. I hope things are starting to sink in. Stick around to the end, of course. I'll do a bit of a faster breakdown of the 4 just to really make it sink in. Second on the list of valuing a commercial business, gross profit multiplier. The gross profit multiplier or GPM method is a valuation approach often used particularly for commercial businesses where sales or gross revenue are a significant indicator of value, right? So with an investment property like the first one we use, we don't have any sales coming in per se, do we? We're looking for businesses such as retail, restaurants, or even service-based industries to use this method. When you see that word gross profit, right? Gross profit multiplier, just think we are selling something this time. You have a good understanding of the gross sales, you know the cost of goods. However, with this method, we still actually need comparable properties. So for example, if you had a restaurant and it had gross sales of 500,000 per year and cost of goods of 300,000 per year, and you had determined based on market data of other similar businesses, the gross profit multiplier was 3x, you would have a valuation of that restaurant at 600,000. So to break that down so it sticks, you need gross profit, right? You need sales and multiplier. You still need comparable properties to determine that multiplier. Here is one interesting thing, right? Let's try to put ourselves in the potential shoes of a buyer, maybe a buyer that's buying a restaurant. Maybe they own 3 or 4 restaurants currently and they keep visiting this one, right? They're familiar with the area, but they just know that they're doing something wrong, the staff is doing something wrong, and they've done their comparables. They know they're at a 3x, 2x multiplier, but they know if they purchase this, they can take that up to a 4, 5, 6, just based on how they know how to run a business. These are the things they will look for to make sure if this is a good investment property or not. Bit of more real world talk there, but sometimes that can help as well to make it stick. Note as well with this method, there is some variance out there. Some people that do this calculation basically based in this method, They don't subtract cost of goods. This is again choice because some potential buyers, they're so familiar that all they need is the gross sales because they have a good understanding of what those cost of goods are going to be. Okay, on to third on the list, the adjusted book value and asset valuation methods. These are grouped together because they both are more or less related to assets, of course. First part, adjusted book value, means exactly that. When you are looking at the books, for instance, there could be a difference, there could be a discrepancy in what you have in the books and what's actually current, possibly selling this asset in the current market. This method can be used when assets are significantly undervalued or, of course, if they actually are overvalued. An example would be if you are valuing, let's say, a small manufacturing building that maybe is going out of business, and in the books it shows that some of the machinery is valued at, let's say, $400,000, but after your due diligence you find out that it's actually valued at more like $800,000. You would look at this discrepancy and you would adjust the books. Second part, very straightforward. Again, it's in the name, asset valuation method. It's particularly useful for businesses that are very asset heavy, such as manufacturing equipment, like mentioned, or even a lot of inventory in stock. When a business's value is very predominant in the fact that it is asset based, this is where you would use this method, opposed to like gross income or cash flow. On to fourth and last on the list, and then again, we'll do a bit of a summary to really help make it stick, is the discount cash flow method. I saved this one till the end because it is considered the most detailed form of investment analysis, most detailed and most confusing. I'm here, right? This channel is here to help you identify what you need to know to pass the exams. You won't have to be making any in-depth calculations like this, so don't stress. I need to just get you a good understanding of this so you can identify it on the exam and pick it out from the others. The Humber material itself, although quite simplified but very hard to read, is even overkill for what you need to know on these exams. This method is particularly useful for properties with predictable income streams, cash flow, right? Like the name, and it goes further as in 5 years into the future of possible sales. It also uses a discount rate. This discount rate can be quite complex to determine, and the rate used for discount takes into consideration the risk at the time a buyer needs to recover their investment. Okay, so those are the four. Let's line them up again and add these small little tips and tricks to memorize them. First, direct capitalization. Again, simplify things for yourself. Just refer to the name. Capitalization, think cap rates will be used. Think smaller businesses like an investment property, rental income. There are no sales like a retail store or restaurant, and think we are valuing it based on a shorter term, 1 year. Second, gross profit multiplier. Again, refer to the name. Gross profit, think sales. We are selling something, and gross revenue is a significant indicator of value. But also think about the multiplier. This is 2, 3, 4, or higher X multiplier. It all depends on the comparable properties. But for example, if it was 3X annual gross sales, so if it was a restaurant with $200,000 in sales, gross revenue over a 1 year period, you would multiply that by 3. On this one, just remember there is that variable. Some people choose to make this multiplier just gross sales and some minus the cost of goods. That is also in the Humber material, and it mentions that variable as well, so don't stress. It won't make you know one or the other for the exam because it is a variable. Third, adjusted book value and asset valuation. Again, think assets just like the name, like machinery or inventory. Think the book may have to be adjusted if these assets are more or less valuable, and think you will still have to do your due diligence to find out the market value of these assets out there. You'll still need to see comparables to come up with these possible adjustments. Fourth and last, the discount cash flow method. Think predictable income streams, sales, cash flow, right? Like the name, longer term value into the future, as in 5 years of possible sales, and this one uses a discount rate. Again, just like the name of the method, and that discount rate is used to consider the risk and the time a buyer needs to recover their investment. So screenshot this if you like, for sure, to have it to refer back to before the exams. I know course 4 can be extremely hard for people, especially if you're not getting into commercial. If you are, that's fantastic. If you aren't, either way, we need to know this stuff to pass the exams. And like mentioned, if you are looking for that additional support to pass these exams, first try or crush a retake, look to my Exam Master mini courses in the description below. It's mini notes, mini quizzes, my exact fundamentals I use to pass all exams first try and in 4.5 months, and I do video breakdowns of the 4 types of questions you may see in the exams. Those links in the description below as well are value links for the YouTube family for the time being. Reach out with any questions at all, guys. You can DM, email, comment on this video. I get back to everyone. My name is Callum Moore, eXp Realty real estate broker here in Ontario. Thanks so much for watching again, and we'll see you in the next one.